Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 295 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, I want to talk to you guys about ETFs. And if you don't remember what ETFs are, do not worry. We'll get right back into it, okay? We'll talk about ETFs. We'll talk about what ETFs are used for, how they may be useful in your own investing life. But specifically, what I want to end up with today is talking to you about how the rules behind ETFs might be changing. And I know I've talked to you about how rules behind other things that we may use in our investing lives and our retirement lives might be changing, but rules behind ETFs may be changing, and we need to know that given just the vast size of the global ETF market. So stick around for all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who watches or listens to this show on a day-to-day basis. Now let's just rehash what an ETF is. First and foremost, what is an ETF? Okay, well, first of all, ETF stands for Exchange Traded Fund. Okay, and that's because it's traded on an exchange just like stocks are. Okay, so this is something that we can purchase, that we can buy as an investment vehicle. Okay, and it is exchange traded just like stocks. We can buy it or sell it from other individuals at any given time during the day at whatever the prevailing price is. The price of an ETF shares will change throughout the trading day as the shares are bought and sold on the market. This is unlike mutual funds. Okay, we know mutual funds are where a bunch of people get their money together. They give it to this mutual company who goes out and buys shares of stock and creates these funds that track these different things, whether it be large cap equities, small cap equities, corporate bonds or investment grade bonds or short term bonds, whatever. Right? They make mutual funds for everything. Well, they also make ETFs for everything. Right? ETFs and mutual funds are not all that different. Okay, the only difference is that ETFs are more cost effective and more liquid when it comes to the ability to trade them, and when it comes to some of the specifics, whether it be the expense ratio that ETFs have, which can be a little smaller than that of mutual funds of the exact same type, or whether it comes to the ability to trade throughout the course of the day, or the tax liability associated with each of these types of accounts, which I will be talking to you about today because that may be where the change lies, okay? Now, before we get into that, let's continue talking about ETFs. Let's get a better understanding. An ETF is a type of fund that holds multiple underlying assets rather than only one like a stock does. Because there are multiple assets within an ETF, they can be popular for diversification. Okay, and most people do this. They buy them within their IRAs. They buy them within their individual investment accounts. They buy these because they are very easy to purchase. They're not extremely costly. And you can purchase shares of ETFs and track the entire market, or track certain sectors, or track whatever the ETF says you can track, right? There's so many different things that ETFs can do, and there are tons of ETFs out there. The size of the global ETF market is approximately $9 trillion. Okay, so this is no small market. This is no small thing. This is a huge thing. And if you haven't heard about ETFs by now, then you're likely missing out in your investing life, or you're just learning, in which case I would be very glad to help you along and teach you as to exactly how all of this investing stuff works. And you need to understand what ETFs are. Now, an ETF can own hundreds or even thousands of stocks or bonds or whatever across various industries, or it would be isolated to one particular industry or sector. Some funds focus only on U.S. offerings, while others have a global outlook. For example, banking-focused ETFs could contain stocks of various banks across the industry, whether that's within the U.S. or worldwide. Okay, so you can find ETFs that track just about anything. Now, there are various types of ETFs available to investors that can be used for income generation, speculation, price increases, and to hedge or partly offset risk in an investor's portfolio. Here's a brief description of a few, okay? So let's just talk about a few of these different types of ETFs. First, you can have, obviously, stock ETFs. Now, this is just a basket of stocks that you end up purchasing that tracks an industry or a sector or tracks the entire market or whatever, right? But you can buy stock ETFs. And obviously, the returns that you get are a function of the returns of the entire portfolio that is held by that particular ETF, okay? And that goes for any type of ETF that you hold. The return that you get is just a compilation based on the weights of each holding within the ETF, and then it's just a weighted average that you get that particular return. Then there are also bond ETFs, right? Bond ETFs are used to provide regular income or provide some stability to a particular portfolio. Their income distribution depends on the performance of underlying bonds. They might include government bonds, corporate bonds, state and local bonds called municipal bonds, or other types of securities. Unlike their underlying instruments, bond ETFs do not have a maturity date, right? So we can hold bond ETFs for however long. They'll just continue buying things within that particular ETF, even as the bonds within it mature. And they generally trade at a premium or discount from the actual bond price. And you can learn more about bond ETFs. I don't want to spend way too much time there, but they are available to you. Then obviously there are industry or sector ETFs. You can buy technology ETFs, healthcare ETFs, banking ETFs, all these different things, right? You can track a myriad of things when it comes to the exchange traded fund market. Not only that, there are also commodity ETFs that may track the price of gold or track the price of oil or corn or whatever it may be. You can track all of these things if you have a broad commodity ETF, or maybe you have a commodity ETF that tracks just some specific sets of commodities, maybe without gold in it or without oil in it or whatever it may be. Then there are currency ETFs, which are pooled investment vehicles that track the performance of currency pairs consisting of domestic and foreign currencies, and they serve multiple purposes. They can be used for hedging. They can be used to make bets based on political and economic developments for a country. They can be used for inflation hedges, right? You can hedge inflation with currency ETFs. So those are a possibility. Then there are also inverse ETFs, okay? Inverse ETFs, they attempt to earn gains from the stock declines by shorting certain stocks, okay? So there are inverse ETFs to the S&P 500, inverse ETFs to just the broader market as a whole. The problem with the inverse ETFs is that with an inverse ETF, you could only go to zero, right? Inverse ETFs are typically short-term plays, just like shorts are. Shorts are typically shorter-term plays, and you don't want to stick around too long with an inverse ETF. Again, I'm not telling you to buy any of these types. I'm just telling you how broad this market is and how many different types there are. And leveraged inverse ETFs get people into a lot of trouble because then their negative returns that they can get over a long period of time can be magnified, or even in a short period they can be magnified. And so nonetheless, in the U.S., most ETFs are set up as open-end funds that are subject to the Investment Company Act of 1940, except where subsequent rules have modified their regulatory requirements. Open-end funds do not limit the number of investors involved in the product, so as many people who want to get into ETFs can. And this is a particularly important point when it comes to ETFs, is that we are not buying or selling ETFs from a company. We are buying and selling ETFs from one another, right? If I hold a share of an S&P 500 ETF, like the VOO from Vanguard, right? That's the Vanguard 500 Index ETF, okay? I hold a share of VOO. I want to sell it for some reason, right? I sell it. Well, another individual or another institutional investor is going to buy that ETF share from me. Right? I'm not just going to sell it back to the company like I would with a mutual fund. Right? Now, what happens with a mutual fund is when you have buying and selling within the mutual fund, right? So they need to rebalance their portfolios, or they need to get out of one position and get into another, or whatever, right? That can create taxable events for investors because there are gains that occur within those portfolios. The difference is with ETFs, that's not the case. The only gains that you have to report when it comes to ETFs are the gains that you actually made in the returns that you had, not the buying and selling of securities within the portfolio, the mutual fund, the ETF itself, okay? Which brings me to today's point. Okay, today we got more information about the tax proposal from the Democrats. Okay, I know I've talked about the tax proposal already, but there is new information out there. They're trying to get to this $3.5 trillion number. They're trying to find ways to tax the rich, and they think taxing ETFs more is going to do that. I don't agree with them, but we're going to talk about exactly what they are proposing. So let's just get into this article from CNBC that says Democratic plan would close tax break on exchange-traded funds. So here we go. Senate Finance Committee Chairman Ron Wyden, Democrat from Oregon. I've said that name a few times on here because he's kind of leading this whole charge, has floated a new levy on exchange-traded funds to help pay for the Democrats' $3.5 trillion budget package. Exchange-traded funds, or ETFs, are a basket of assets such as stocks or bonds that can be bought or sold throughout the day like a stock. While everyday investors don't directly own the shares, a fund manager may buy or sell the underlying assets to financial institutions, which this is all true, and this is what we just talked about. Regular investors typically avoid taxes while owning the fund because financial institutions can swap the underlying assets for others, known as in-kind trades, which do not trigger capital gains. Okay, so this is important for us to note, right? These in-kind trades do not trigger capital gains. Wyden has called for ending the tax break for these in-kind transactions, according to the proposal, which may affect all investors across the $6.8 trillion U.S. exchange-traded fund industry. Right, so it's a $9 trillion global industry, but $6.8 trillion of that is in the U.S. The plan aims to crack down on the financial institutions that bypass capital gains taxes. Right, we're only talking about the taxable accounts of the wealthiest investors. Not really. But anyway, this is what Wyden said in a statement. As the plan exempts ETFs and tax-deferred retirement plans such as 401k plans or individual retirement accounts. This proposal simply applies the same rules already in place for corporations to regulated investment companies, so wealthy investors can no longer avoid all tax on their gains, he said. Fund managers use the in-kind trading strategy to get rid of appreciated assets without creating a taxable transaction. Seems like a logical thing to do, right? If you can do that, seems like a logical thing. For example, a fund manager may tell a financial institution to deposit stocks, and the financial institution redeems the assets the manager wanted to sell 2 days later, known as a heartbeat trade. Everyone uses heartbeat trades when they're going to be rebalancing, said Fordham University law professor Jeffrey Colin. Right? Wyden's plan to tax in-kind trading has already received pushback from the ETF industry, saying that the plan may hurt smaller investors as they could be liable for taxes as well. And undoubtedly, they would be liable for taxes as well. Wyden's proposal may raise $200 billion over the next decade, according to preliminary estimates from the Nonpartisan Joint Committee on Taxation. However, lawmakers are still debating ways to fund the $3.5 trillion budget. As the Senate Democratic Caucus continues to look at the menu of tax policy I've put forward, the package of loophole closers will be an important part of our conversation, Wyden said. So they are trying to close a lot of loopholes. They are trying to tax our investments, basically, right? If you're trying to do smart things with your money, if you're trying to take your retirement into your own hands, if you're trying to take your investing life into your own hand, they are trying to slow you down. They are trying to keep you from doing the things that I have taught you to do on this show. They're trying to keep you from investing in the things that are going to be beneficial to you over a long period of time. Now, they do all this in the name of making sure that the wealthy don't get breaks on their taxes and making sure that the wealthy pay more and all this type of thing, right? But ultimately, the people in the middle or lower class that this is going to be okay for is those who do not have investments in the first place. So the assumption is that the middle and lower class don't invest. And that's not true at all, right? If you even remember what I talked about earlier this week, I was talking about, the taxation on IRAs and 401ks and how they said, this is going to promote the investment of the lower class and the middle class, right? This is going to promote their ability to invest for retirement and all these types of things. Well, this isn't, right? This isn't going to promote my willingness to invest in ETFs, right? One of the things that makes you want to push ETFs in the first place is the fact that there is taxation benefits, right? You don't have to be taxed on the gains within the account itself, right? All you have to be taxed on is your buying and selling of whatever it is, which is beneficial to investors, undoubtedly, right? And I understand you're trying to find ways to fund this particular tax policy. Let's look again. It said the proposal may raise $200 billion over the next decade. They're trying to spend 3.5 trillion today. 3.5 trillion, not billion, trillion today, right? And in trying to do so, 200 billion over the next decade. Again, not even a drop in the bucket. That's something that I think is very interesting to note when it comes to these crackdowns on retirement accounts and crackdowns on these different investment vehicles that we use every single day or every single month or whatever, right? Is that they're not making a big difference. Right? They're doing this little by little to try to find, 1,000 different ways to get to $3.5 trillion. But the truth of the matter is that they're just not getting to those numbers by trying to do what they're trying to do. And ultimately, what's ended up happening is every move that they make, even though, yes, it may force the rich to pay more taxes. Okay, I get it, right? It's likely going to force them to do so. I 100% understand. But it's also going to force people like you and me who may have ETFs within some taxable accounts and say, okay, I'm investing there so I can, pay for my kids' college, or investing there so I can save up and put a down payment on a house or whatever. They're increasing our tax liability. Now, it may not be a huge tax liability, but nonetheless, they can increase our tax liability. And this is hypocritical. Right? The reason that this is hypocritical is because we've all been told, oh, if you don't make more than $400,000 a year, your taxes won't go up. Your taxes, they won't go up. Don't worry about it. This doesn't affect you. Don't worry about it. Don't think about it. And that's what they want you to do. They want you to not think about it. They want you to not worry about your tax situation. But ultimately, what they're doing is not just messing with the wealthy, even though this will affect them. That's what I want you guys to understand. Of course, this will affect the wealthy. But it's also going to affect those of us who do this ourselves, right? Unless they decide on the back end to come and put some income limits on this or whatever, right? Or some wealth, limits, whatever it may be, right? I'm not saying they won't do that, right? I'm just saying as it stands today, you close these tax breaks on ETFs and I'm going to have an increased tax bill. You close tax breaks on ETFs. A lot of people like myself who don't make, hundreds and hundreds and hundreds of thousands of dollars a year, or $1 million a year, or have, tens of millions of dollars laying around, or $1 billion laying around. Those of us like me are going to have increased taxes one way or the other. And you may say, oh, well, it's not a lot, but it's nickel and diming us, right? First, you're looking at, your 401ks, your IRAs, they're starting to crack down on those. Then they move to these ETFs, which individuals are wanting to use to invest for retirement. They are slowly taking away the tax advantages that are available to investors, right? And this is not good to promote investment, right? If you are trying to promote investment from the middle class, this is not good. If anybody is interested in paying less in taxes, it's the individuals who are paying high percentages in taxes, right? Of course, yeah, if you're going to crack down on Elon Musk or Jeff Bezos or whomever who pay low percentages relative to their wealth, right? Then yeah, this is going to stink for them, right? Not just this, but some of these other plans as well might stink for them, okay? But ultimately, you have individuals who don't make that much in income. You have individuals who may make $75,000 a year who are doing all the right things or trying to do all the right things, and you're taking away their incentive to do so, their motivation to do so. And I know it's not eliminating these incentives, at least not yet, but slowly but surely, some of these incentives are going away, and who's to say that they'll ever come back? Not to mention, if you close the tax break on ETFs, why are ETFs so interesting anymore, right? Yes, of course, you can trade them throughout the day. I don't think they'll go away. Right? I don't think they'll go away. You can trade them throughout each trading day. I understand. Right? People will still use them. Okay, but there's not another tax incentive on top of it. Right? And if you're somebody who has some higher amounts of wealth and you have money in ETFs, and that's the reason that you have it there in the first place, your money might get put into other places where you can try to avoid taxes all the more. Right? Ultimately, this is just a grab for tax revenue, and I'm not thrilled about it, right? And this is not to say it'll pass. Again, these are all proposals and plans and all these types of things. And there is a lot of pushback. And the ETF industry, being a $9 trillion global industry, I'm sure is not going to be thrilled about this because people want to get into ETFs for this reason, and that just makes them more and more money. And if people flow out of ETFs for any particular reason, like this increase in taxation, then, they'd be hurting. So they have incentive to keep this from occurring. So I'm not saying this will occur, but I'm just saying that these grabs for tax revenues, especially in places that the everyday individual transacts, is kind of worrisome. Right? It's kind of worrisome to think that the places that they're reaching now for tax revenue are the places that everyday individuals are trying to get their retirement right, trying to get their income to work for them over a long period of time, and they're not incentivizing you to do so. Now, I say all this may scare you. I don't know. Okay. But I'll tell you this. Ultimately, is it going to keep you from getting to where you need to get to? That's the question that I want to ask after all of these potential tax increases and all these types of things. Are these increases going to keep you from where you need to get to financially? And the answer to that is overwhelmingly no. Okay? Even if they got rid of the tax break on ETFs, what do they become like? They become just like mutual funds, right? We know mutual funds, this is already the case, right? This is already the case that this is occurring. So this is not like we're missing out in a large way. Yes, does it take away one of the advantages of one of the biggest financial products that's blown up over the past couple decades? Of course it does, okay? But it does not take away our ability to grow our money over a long period of time. It absolutely does not. And especially, even if you hold ETFs or mutual funds for that matter that have low turnovers in the first place, and turnover is nothing more than the buying and selling that they do within the portfolio, right? So the less buying and selling they do within the portfolio, the less that this will become an issue, right? And we've been shown, we know that lower turnover, lower cost mutual funds and ETFs tend to work out better over a long period of time. And this is specific to things like index funds, right? Index funds are going to have lower turnovers and you're going to have lower costs associated with those as well. And they have tended to outperform the active managers over long periods of time. So again, does this mean that we can't do it? No, it just may mean that there's a little more when it comes to the taxes of everything. And again, the thing that I like about this particular type of proposal is that they're not going to do it to retirement accounts. They're not going to do it to your 401ks. They're not going to do it, which 401ks, you don't really see ETFs there anyway, but they're not going to do it to your IRAs, right? They're not going to do it in those tax advantaged accounts that you already have, which is, useful, which, I like that. That's fine. But ultimately, they're doing other things in those places. They're reaching for tax revenue in other ways there. So let's just let them keep holding their ETFs in that way, because ETFs wouldn't affect those individuals anyway. What's going on within ETFs wouldn't affect those individuals anyway, because those are already tax-free or tax-deferred growth, right? So you're not having to pay for the growth that's occurring within the account. Whatever. That gets included in the statement, but ultimately, them saying that they exempt it, it wouldn't matter if they did or not. That growth doesn't get taxed within those types of accounts, okay? But ultimately, what do I want you to do? What do I think you should do about this? What's our action on the back end of finding out that ETFs may lose some of their tax advantage? Keep investing, and keep investing systematically. Keep investing over a long period of time. Keep putting money away into ETFs. Keep putting money away into mutual funds if you don't feel comfortable with ETFs anymore because they're cracking down on some of the things that they're doing. Whatever you want to do. But I promise you this, even now, if all these proposals go through that we've talked about, about taxes the past couple weeks, if all of these proposals go through, and which is not extremely likely, if they all stay the same way that they are today, they all go through, right? And, they become law. We can all still save up money and become wealthy. We can all still, whether you're just putting money into a traditional brokerage account, you can invest over a long period of time and have a lot of money when it's time to retire. You can do it. Now, are they slowly eating away at this? And the concern is not necessarily just today, right? Yes, they take away a tax advantage here, a tax advantage there. They put some caps here, some caps there, right? The concern is not today. The concern is, what do they take next, right? What is going to be the next proposal that says no more Roth IRAs, right? What's going to be the next proposal that says, you have to start taking required distributions as soon as you retire? Okay, what's going to be the next thing? Because you can see these types of things snowball. If they can take something here, maybe they'll need more tax revenue later. And if they're already reaching for places that the individual investor, the normal individual, the middle class individual would invest their money, if they're already reaching there, then where are they going to reach next? That is what concerns me. Now, if you're somebody who's not too concerned by this, that's fine. You don't have to watch it. You don't have to listen, whatever. I'm fine with that. Okay. But as somebody who wants to build wealth over a long period of time and is working towards building some substantial wealth over a long period of time, and speaking to individuals that likely want to build wealth over a long period of time, likely want to be building up the amount of assets that they have, I think we should all be a bit concerned. Okay. I don't think it should force you into not investing. I don't think it should force you into not acting, right? I think we ultimately all have to find ways to continue to invest and grow our money over a long period of time. We have to do that. Okay. But we need to be knowledgeable and be thoughtful about the ways in which that's possible. Right? If the way in which that's possible is not through 401ks and IRAs ultimately, then we'll change course. And like I've told you before, I'll be right here changing course with you. I'll be right here showing you the way into the new, investment life that we may have at some point. Right? We need to stay on top of these things because if they change, it may change the way that we invest. I've told you this before when it comes to investing in things like individual stocks, right? You buy it and you hold it until the story changes, or else the reason that you bought it doesn't make sense, right? You want to buy it until the reason that you bought it is no longer true, right? So it's the same thing with IRAs, Roth IRAs, 401ks, ETFs, whatever, right? If the reason that we purchased them in the first place is still true, then we're fine, okay? Or if the overwhelming thesis is still true, because ultimately, yes, a tax advantage can be useful and may have been one of the reasons. But if it's not, going to impact you in a large way, then keep investing. But ultimately, when the story is no longer the same and we have to find something different to do, we need to change, and we will move, and we'll move together. And I'll do the research and I'll do the homework and I'll talk you guys through it and I'll help you if the story is to ever change. I hope the story does not change, right? I hope that we continue in this way where we do have the ability to invest in tax advantaged ways over a long period of time. And that's the thing. We're losing tax advantaged abilities to invest. And people may argue, well, you're not a billionaire, so it's not affecting you in a huge way. I understand. Right, but what does happen when I've got a $15 million Roth IRA? Right, we've talked about what may happen earlier this week. Right, what happens when I'm an individual who makes any amount of money or who has any amount of wealth, but maybe that wealth's in a taxable investment account in ETFs, and I'm banking on it being very tax efficient in that place. Maybe I have an actively managed type of ETF, and then you're taking away that tax advantage. Look. All I'm saying is that we need to keep our ear to the ground. We need to be understanding of what these proposals are. And yeah, I may be rooting on them not to pass. Okay, but ultimately, if they do, we have to be flexible. We have to learn how to move with the changes. Because ultimately, when the Roth IRA came on the scene, people moved into it, right? People found out it was a good thing to have, right? Over time, as the capital gains rate has gone up or gone down, or as the income tax rate has gone up or down or whatever, right? People have adjusted. They've changed their strategies when the story changes. And I think that needs to be our outlook on things as well. I'll be right here to help you. It's not, killing us right now, but that's not to say that it won't ever. Okay. So just keep your ear to the ground, stay understanding of what's going on, and keep taking advantage of these good investment accounts, these good investment instruments like the ETF until they are no longer beneficial to you. But right now, I think they can still be beneficial, especially as we do our retirement investing and invest in our 401ks and IRAs and things of the like. Okay, so I'll be here to help you. Just keep investing, keep pushing towards your long-term future. And I promise you, you can still get wealthy. You can still push towards long-term financial freedom. I will shoot you straight. And I always believe that'll be true unless some extremely drastic things were to occur. Okay, so keep going, stay the course, and you will be fine. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me your review review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in Monday as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.